Hello, everybody, and welcome to our annual version of Roundtable Prime for the 2026 edition. We were talking about this last night, that we've been doing this for over 7 years now. I think this is the 8th one that we've hosted here at the DoubleLine offices. So thank you guys for participating with us. We have a live audience with us today, sitting in the room. We have some of our prestigious clients, but on top of that, we were live streaming to a lot of you out there as well today. So thank you for your time. And we hope to make it entertaining and, more importantly, very informative. So to my left, we'll start with the panel. I'm Jeff Sherman, by the way. I'm the Deputy Chief Investment Officer here at DoubleLine. I will be your moderator for the conversation today. And I probably won't say too much given how well-spoken all these gentlemen and lady are. So to my left, let's start off with our returning champion, right? Isn't that how we described it last night, right?
Liar.
Yeah. He's self-proclaimed he nailed them all correctly. No, just kidding. This is David Rosenberg. He is the president and the chief strategist at Rosenberg Research. To his left, also a president of his own economic research firm. This is Jim Bianco, as well, for Bianco Research.
President is something.
Right? I mean, if no one will elect you, you just inherit yourself, right? To his left is our CEO and founder of DoubleLine, Jeffrey Gunlot. To the left is Charles Payne, and he has a dual title here. He's the hardest working man on the stage. He's not only the founder and the president of Wall Street Strategies, but he's also the host on Fox Business of Making Money. What a great name, right? Making Money. Don't we all want to do something? Yeah. And not last, but obviously not least, right? To his left, that's Danielle DiMartino Booth, and she is the president and chief strategist over at Quill Intelligence. So I'd like to welcome everybody to coming back. Thank you for joining us again. What a better year it is this year. And I say that because we're not ravaged in the middle of fires like we were 1 year ago when we had this event. So thoughts to everyone out there that suffered through all of that. But let's just start off with kind of the just what is the macroeconomic backdrop? I'm going to start with you, Rosie, to my left, because we've talked a lot about the integrity of economic data. We've seen, the shenanigans with getting rid of the heads of BLS. We've seen kind of the manipulation of some of this data. It seems like, we're going to use, the CPI numbers. We're going to interpolate those to get us the PCE number because PCE looks a little high right now versus that. But going back into your own data sets, right, and the way you look at the world, how are you feeling about this economic environment here in North America as we go into 2026?
Right. Well, great question. I'd say that it's probably accurate to say that there's a lot of doubt over the quality of the government data. Not that I would necessarily fire the BLS commissioner over it, because it really wasn't her fault. But there's an array of private sector data, that didn't exist actually when I started doing this back in the mid-1980s. So you have a plethora of private sector data, what people call second tier or survey data, that are signaling something that the stock market isn't really pricing in, if it really matters, which is a very soft underbelly to the economy. So for example, this week we got the ISM manufacturing data. And this includes, the boom that we're seeing in terms of what's happening with AI spending. And what was interesting about the ISM, which goes back to like 1948. And, when I started in the business, ISM actually was something that was closely watched. It still is, maybe not as much as it used to be. And I was struck by the fact that only 11% of industry in the United States in December was in expansion mode. That was down from 22% in November, down from 33% in October, and tied for the second lowest share of industry in expansion mode since April 2009, when the Great Recession hadn't even ended yet. And we got the ISM services data that came out this week as well. Only 50% of companies in the service sector are expanding. So there is this divide, I guess you could say, between the government database, in some sense, 4.3% real GDP growth in the third quarter. I think there are big problems with that number. But the private sector data, whether you're taking a look at consumer confidence or you're taking a look at surveys of purchasing managers and businesses, it's a pretty weak economy. I'll just say that 40 years in this business, I don't remember a time where everything was just so confusing and complex. And I hope what gets resolved this year is this K-shape to the economy that we're talking about, and I think everybody knows about when we talk about the K-shape, it comes down a lot to focused on the consumer, and that we know that the stock market wealth effect is benefiting the very high end. That's the glue keeping the consumer together, and that the middle income consumer, low income consumer is either in stagnation or contraction mode, but more than offset by what the fat cats are doing in terms of their expenditures. But the K-shape or the bifurcation, the wide divide in the economy transcends what we're just seeing in the consumer space. Like, for example, let's look at capital spending. So you've got AI and related technology related spending in volume terms this past year was up at roughly a 20% annual rate. I would classify that as a boom. But when you take a look at the rest of capital spending, what we used to call, say, the old economy, spending there was actually negative 5%. So you've also got this bifurcation, not just in the consumer space, but also in the general business expenditure space. And I'd say that the biggest K-shape of all, the biggest K, and I would argue the most important market, at least for an economist, is the labor market. And the K-shape there is that we do have what's referred to as a no fire, no hire labor market. And that came through loud and clear in one specific data point this week was the JOLT survey, the job opening labor turnover survey, which shows you the engine. It's actually, I think, even more important than non-farm payrolls, because that shows you the hood of the car. The JOLTS data show you the churning beneath the veneer. So hiring rates are way down. There's no hiring activity going on, but companies aren't firing people either because of the miserable memory of having done that when the economy was locked down during and post-COVID, and then you couldn't find these people again. Companies are finding ways to rationalize labor by cutting their hours, and we saw that, by the way, in the productivity numbers today. But they're not laying people off, but they're not hiring. And I don't know how sustainable that is, because when you have a situation where no hiring, no firing means that there is zero growth in employment. And in fact, when you trend out, whether it's the household survey, the ADP data, the non-farm payroll numbers, we'll get a fresh set of data, a clean set tomorrow. Employment growth, when you trend it out, is running close to zero. And that's the no hire, no fire. It's basically a totally sclerotic labor market. But you see, the thing is that even with the immigration curbs, we're still getting natural flow of people coming into the labor market. We're still getting labor force growth is slowed, but it's not negative. We're still getting more than 100,000 people coming into the labor market every month looking for a job. But yet there's no jobs. Job openings are way down. Companies are not hiring. And that is going to continue to put upward pressure on the unemployment rate. And I think, and we'll get into this later, what that means for the Fed and what that means for interest rates. We've already seen the unemployment rate go from 3.5 to 4.6. I think, and I'll talk about this later when we talk about what it means for interest rates, but I think we finish this year, if something doesn't change in this no hiring, no firing, and you look at the labor force flows, I got bad news for the Fed. We're not at 4.5% unemployment by the end of this year, which is their forecast. We're at 6%. And that's going to have all sorts of other, shall we say, economic, societal effects on inflation, but also interest rates and what it means for the midterm elections. So that's my view on the economy. It's tough to really sit here and say that we're in a recession, but I don't really need to have a recession call. If the unemployment rate is going up, it's telling you that the labor market is going from excess demand to excess supply. And that is fundamentally disinflationary. And that's not priced into the bond market or the money market right now. So that's my general view.
Okay. And then, so Jim, as you've been kind of distilling this too, I want to pick up on what Rosie was saying there about, kind of this net immigration. We're talking about there being, there's less labor demand, but we're also seeing less labor supply due to the net immigration issues. There is still a growing kind of labor force participation. We're seeing some of the people coming back, which has helped the unemployment rate go up. How are you looking at this right now? Do you feel that we're at that Jay Powell's equilibrium he talked about 6 months ago, where he talked about this, where there was the diminishing demand and diminishing supply, or do you feel differently?
Yeah, this is in my mind, this is the question for the economy, even ahead of tariffs. Economic growth is driven by two major factors: population growth and productivity. What is population growth in the United States? Well, most of the data that we get is usually yearly data, and it's published in the fourth quarter, because for 200 years that was good enough. I need to know by October of 2025 what was 2024's population. Today, something has changed, and that is the immigration flows have dramatically changed since January 20th of last year. And we would like more high frequency updates as to where the population is in the US. If you look at the Dallas Fed, you may be familiar with them, they put together a model based on what we understand population flows. What is the labor break-even rate? How many jobs does the U.S. need to meet its population growth? And they estimated it at around 30 or 40,000. But if you listen to Trump, he says that there's been no net immigration into the country in 6 or 7 months, zero illegal immigration, and 2.5 million deportations. That's if you listen to Trump.
Wait, Jim, can you provide context when you say that 30,000 number? What was it historically, or what has it been at various parts of cycles? Because I think that context is important if people don't follow this data like we do.
So in 2023, when the population growth, when we were getting 3 million undocumented workers a year into the country, that number was approaching 250,000, that you needed to create 250,000 jobs a month to meet the population growth. Prior to this whole immigration thing, it was around 75 to 120,000 a month is where it was, say, before COVID. Now it's at 30,000 because the population growth is. The point is how many jobs does the country need? The first question is, how fast is it growing? And we know that we have low fertility rate. We've been below replacement rate for a generation in the country. So all of our population growth has come from immigration. So if you put it in what Trump said, we've had no immigration for 6 or 7 months. We had 3 million come into the country in 2023. And he says 2.5 million deportations. If you put that in the Dallas Fed model, the break-even rate's minus 70,000 right now. Well, that's probably not a realistic number. That's Trump hyping things. And if you put it into what people are guessing, demographers are guessing what is going on with immigration and with deportations, you would come up with a number of around 10,000. So the big question is, maybe what you said, Rosie, is right. Maybe we are producing near zero jobs, maybe slightly positive, but maybe that's all we need. Because if we have no population growth, that's all we need. Now, you mentioned about labor force participation growing, but again, a lot of that number comes from estimates that were set last year before Trump closed the border. We don't have a way to real-time estimate what the population is in the country. And I want to emphasize, for 250 years, we never had to do it until we ran into this unique situation that we have now. So we're all kind of guessing. And that, to me, is the biggest issue, is because the population growth of the country is the first thing that will tell you where economic growth is going to go. After that, it is productivity.
Yeah, I mean, it doesn't sound like a lot of population growth, so it sounds like there's a lot of reliance on the productivity side, right?
Yeah. So just to give it an example, in September, Jay Powell addressed this issue, and he said that there's credible estimates that the labor break-even rate is somewhere between zero and 50,000. And I would gather that his biggest problem is, maybe he agrees that it's close to zero, But can the Federal Reserve Chairman stand at the DS and go, hey, we're not producing any jobs, but we don't need any jobs. We're good. We're good with no job growth. We'll hold the funds rates steady. You think Trump's upset with them now. Try trying to pitch that story. So it's almost like he knows it, but he can't say it. And or if he doesn't believe it, he's not trying to dissuade it in any way. So, but the 0 to 50, I thought is the takeaway is there's a lot of guesswork going on here. But what we do know is there's been a fundamental change in the population growth of the country. One last thing about population growth. One time in American history has population growth been negative. 1918, the Spanish flu, which killed 20 million people after the end of World War I. Not even during the Civil War, even though 8% of the population died during the war, the fertility rate was 6 to 1, that we still have positive population growth. There's arguments to be made that 2025 could be a 0 to negative population growth. If you believe the Trump's numbers, you would come up with a negative population growth for 2025, only the second time in American history. So we don't really know yet. Maybe by the end of the year, when we get some of the estimates, we will know. But that to me is the big issue is, yes, we know what's happening with the labor market, but what do we need? And that has been changing quite dramatically since we closed the border.
It's very interesting the way you say this because, we all grow up with heuristics and we think we know what it's supposed to look like. We think we know we need these number of jobs. And as you said, every time there's a wrench in the system. And I always say, if we want to teach someone economics, I always say, do you have a job? If so, you get a paycheck and you spend money, right? That is the economy. That's how I teach economics. And we're done, right? I'm a mathematician, right? I'm going to skip down because Danielle, after I've said that now, what do you think is the one most valuable economic data point we should be looking at today? And you can use a multitude of them, but just kind of, again, we've been harping on labor here. Is there something else you would add to that mix?
Well, I think you have to take into account what work people are doing and how much work people are doing and what the underemployment rate is and what the job market is right now for white collar workers, what the job market is right now for college graduates. Those numbers, we're seeing right now an oversupply situation that's put youth unemployment kind of where it was in 1988. But in 1988, we had this surge of baby boomers. It was the peak year that they were entering the labor force. Now we have a lack of demand for these graduates, and I speak to them all the time. And so they're taking jobs that either don't pay them enough, they're not leaving home. Of course, the Census Bureau has told us that we have more Americans, adults, children living with their parents, age of 30, something like that, since the Great Depression. So we try and track really closely what's happening with wages. The JOLTS report was really key a few days ago because it showed that you fell underneath that 1.0 threshold. So now there are actually, for every job opening, there's more than one person trying to get that job in the United States. That has major implications for wage inflation. We are seeing...
Neil, but prior to I think it was late 17, we always had more jobs available than people looking for work. Like if you use kind of the JOLT, if you use the same data set. So I'm curious, should we be as alarmed at that crossing that, that 1-for-1 threshold?
Yep.
But again, maybe it's different now, right? Because of all the other dynamics.
I'm actually not saying it's different now. I'm looking back to the experience of the great financial crisis. So we had fresh productivity numbers out this morning, and productivity is obviously growing gangbusters compared to what it was pre-COVID throughout the 2010s. The flip side of that is, and the question is, how are we getting these productivity gains out of each individual worker? Well, unit labor costs, if you look at the last 2 quarters, have fallen on a year-over-year basis by about 34%. And that number didn't exist in 2007 to 2009. We didn't have wage disinflation this strong on a 2-quarter basis. And that means that workers are being squeezed. And yes, it's a no fire situation, but if you're still working, you're working really hard with a gun to your head. And that's why we're seeing 9.3 million Americans with multiple jobs. That's why we're seeing 12% of Americans now working from home. The employers are taking the baton back. It's the employers that now have the upper hand, whereas for years after the pandemic, there were all these trends where, it was just the take this job and shove it attitude. The pendulum has swung back too far. And now you hear Uber drivers and DoorDash delivery people saying, I used to be able to make enough, but I can't. But you're still seeing, if you're an Uber driver in Pennsylvania, you're making about 15% more than if you were claiming unemployment. If that's the state of California, it's multiples of that you're making more than you would be making if you could be collecting unemployment. But at the same time, we've got continuing jobless claims as of the final week of December, up year over year on a not seasonally adjusted basis. So there is a sclerosis. If you do not have a job, you're not getting a job. And if you have a job, you are working your ass off to keep it. And that's why we're seeing productivity as strong as it is. But will that result in aggregate income growth? Not when unit labor costs are falling by 34% over the last 2 quarters. So it's a very, very, very strange dynamic. But again, I think, to Jim's point about what's changed in the last few years, it's the employee-employer relationship. Because that pendulum, and in my view, that pendulum has swung too far, because you've still got CEOs making, gobs more than what their average employee is. And that there's societal implications there.
I'm going to finish this thought with you, Jeffrey, but Charles, I want to let you chime in here, because we always hear you kind of be more in the weeds on the markets themselves. How are you thinking about this too? Because we can do our bottoms up work, right? But I mean, there's all this uncertainty around this economic data. What are you doing with it?
This is a paradigm shift. I mean, the one word we haven't heard yet is artificial intelligence, the 2 words, AI. I don't think we're talking about that enough yet. And yes, it may be early, but we're entering a phase, and you just alluded to it, David, you alluded to it, where it's a jobless prosperity. Sounds almost oxymoronic. But we continue to create riches, trillions of dollars of wealth, as large swaths of the nation live paycheck to paycheck. And a large reason for that, and a new productivity miracle, is technology, AI, and it will change. It's changing everything, and it will continue to change everything at such a rapid rate. Maybe it's the answer to the fertility crisis. China's come to grips with theirs, so what did they do? They have an industrial robot army out of this world. We're nowhere close to it. They've accepted it. All right. After a few decades of telling people they can't have kids, they won't have kids. They'd rather have a pet than a child. And so that's, I'm concerned about 2 things. The money part of it, I'm not concerned about it. I think this is the greatest time in our lifetime to make money, particularly in the stock side. I mean, it's mind-boggling how much money will be made in the stock market, particularly with individual stocks over the next 2 or 3 years. But the divide in this country is going to be astronomical. And really, we saw some of this with the tariff situation. Capitalism is going to have to redefine itself to a degree in America. Coming into this, since 2009, profit margins were for a long time, about 10%. Now we're approaching 20%. Before that, I have a tape with Warren Buffett, a video when he was saying if a company did 8% profits more than 3 years in a row, he'd sell it because they couldn't keep it going. Now it's not unusual. Again, 17, 18, 19%. Well, what's happened in that same time? Profit margins have gone through the roof. The stock market has gone through the roof. The share of prosperity from labor has crashed. So again, from an investor's point of view, this is a wonderful time. But find an exit plan. Find a place you can take your family on a jet somewhere and live for a few years while they burn down cities. And that's the unfortunate situation we're in, because the AI situation to this is unstoppable. It is absolutely unstoppable. It's hard to quantify right now. A lot of economists don't touch it yet. They say it's not existing yet, but it is existing, and you see it in these new lack of new jobs that you're talking about. Yeah. And this is and I'm going to know to Rosie. I know we're going to talk about the Fed later, but this is what frustrates me with the Federal Reserve, to be quite frank with you. Up until the last meeting, most of them were saying, well, I know there's a lot of pressure, but we go on TV almost every day, particularly the hawks. We can't cut rates because we're worried about inflation. We don't see any evidence that there's a crisis in jobs. Well, the evidence has been out there. And it's not just the survey. I'm not really a big fan of any survey data. I like ISM. The service number was not bad. It was the best number since October 2024. But this high frequency data that we have at our disposal, the Fed refuses to use it. I spoke with Jay Powell. We had an off the record thing. And the only thing I will say is, because a lot of things I'm not at liberty to say, but I will come away with this, that the Federal Reserve, in my opinion, doesn't give a damn about the bottom 50% of America. As long as the numbers hit, we don't care how we got great retail sales, right? If Jeff Gundlach went out and bought everything in America in January, we wouldn't give a damn as long as it said the retail sales were phenomenal. No, they don't care how it happens. They're just looking at aggregate data. You know, a joke I always say is, you went to a bus depot, and let's say the 9 guys were bus drivers, and every night before they went home, they went to a bar across the street and knocked a couple back. And one night they're at the bar, and Elon Musk walks in. An economist would say, last night 10 billionaires were drinking beers. But that's not the case, right? So there's a lot of things we're living in real time. I do think there's a paradigm shift that none of us have a grip on. There's a lot of guesswork, which has been mentioned up here. And I think on one hand, the prosperity that's being created is unmatched. On the other hand, it was going to lead to some serious societal issues and things that people are going to be uncomfortable with, like the notion of universal basic income. Or, Vlad Tennant the other day from Robinhood suggested that, well, people can trade for a living or trade the prediction markets for a living because there won't be a regular job out there.
Yeah, I got a note from my brother-in-law the other day. Said, did you know that Robinhood will let me bet on teams during the game, and I can buy and sell the team in the middle of the game? And I'm like, well, isn't that just this live betting? But he's like, no, but it's on Robinhood.
Yeah.
Have you tried it?
Yeah.
The answer was no. But anyway, shout out to
DraftKings guy.
Yeah. Obviously, I mean, I own the stock, right?
Oh.
But the thing is shout out to the brother-in-law. But it is interesting because for so many, I would say, probably the last couple of decades before the pandemic, labor had no power in this relationship. Mm-hmm. Capital has been driving it for a long time. Labor had that upper hand for a few years. And I've told clients that it will have the upper hand until the next recession. Maybe it's not the recession. Maybe it chips away, and that's where we're going today.
Well, I mean,
yeah.
Charles has posted this chart online, and you see this great big V that goes up where workers did have power for a hot minute. Yeah. And then it's come back down and then overcorrected to the downside.
On that, Jeffrey, I'm going to open up to you to take any of that, but also tell us about your favorite indicators that you used to use.
Yeah, that's actually, you've read my mind.
Well, maybe I sit around you too much.
Yeah. I mean, we're all sort of saying the same thing, looking at the same thing, coming to the same conclusions, but seeing it through slightly different, like Dave talked about the K-shaped economy. I think about it as when people analyze the economy, they look at the on average numbers. Mm-hmm. You look at GDP, it's on average. You look at wage growth, it's on average. But there's a tremendous difference now than there had been, I would say, prior to the pandemic, where everything seems to have shifted. So many indicators that for really a few decades were pretty reliable. Let's just start with the leading economic indicators, which amazingly, with the stock market doing so well, have been negative for years. This has just never happened before, that they're so negative, and yet, on average, the economy's growing. On average, the stock market's doing well, but the stock market is also an on-average situation because it's being driven by massive gains. As Charles's point is exactly right. There's tremendous wealth, but it's more of a stock picker approach rather than you have every company doing well. So many parts of the stock market were negative last year. Yeah, and some of them fairly significantly. I mean, things that always used to be commonly going to, I would say, overly elevated levels, like Chipotle. That was like unbeatable. I could never understand it. How are people paying for this stuff? Because now we're talking about something that isn't a billionaire's venue. It's a guy that needs a relatively affordable lunch sort of thing.
Well, I will say that
downgraded this morning too by some firm, but anyway.
But I will say on the desk we had a discussion because there's the new ad about their $5 protein. You can add on $5 protein of this, and it's like, okay, but it's just meat. Like, it's not like it's some special thing. And then Obviously, sleuthing found out it used to be $4. It's just a new marketing campaign. They upped the price and they called it cider protein.
I feel like we have to decompose data much more than we used to in the past. So you look at things like housing affordability. We all know that it's bad on average. It used to be that the Atlanta Fed does this thing where they take the nationwide average home price and then they factor in what the mortgage rate, and you assume you're using a mortgage to buy it, and factor in taxes, which obviously are tremendously variable. So using the on average taxes is very misleading. And they put in maybe insurance costs. And it used to be that if you took the monthly payment for those costs of owning a home with a mortgage, 28% of the population could afford, with the median income, could afford the median home. That's up to 48%, which is a really big change, and one of the reasons people are so unhappy. But the on average number is terribly misleading. Home affordability in many places is far worse than that. Where we're sitting right now in the Los Angeles metropolitan area for the statistics, it's Long Beach and Anaheim and Los Angeles. It's actually reported that it's 98. It's in the 90s. I can't remember if it's 94 or 98. Yeah. But the median income compared to the median cost of a home in the entire district, it's like in the 90s. But people don't even bother to take into account that that's pre-tax income. It's in Los Angeles, you're paying very high taxes in the Los Angeles district. So actually the servicing the median home, which is pretty expensive in this district, it takes a pre-tax income of well over 100%. So no wonder people are unhappy, because on average they can't accomplish things, and that's what's really responsible for a lot of this social unrest that will just continue to develop as long as we continue to head down this road, and that many people are feeling just fine, and other people just see themselves going further and further and further behind. And so I think it's important to decompose all of these numbers. I also think that somewhere in this mix, Charles is right about the AI. Maybe the AI can be used to one very productive purpose, and that would be rooting out government fraud, right? Rooting out government fraud. The amount of government fraud is beyond belief at the state level, and of course it's being money laundered through Washington, D.C., with the being aided and abetted with a $2 trillion budget deficit. I've come to the conclusion that the slush fund of the fraud is the budget deficit. And so it might be at $2 trillion, and it needs to be rooted out. So we have, and people now, this tipping point with the state frauds and so on that are being revealed, where California is way worse than Minnesota, I'm sure, because it's far bigger. People are starting to feel like, and they're speaking openly about it, why do I feel like such a loser and such a chump for actually working hard and paying my taxes in full and on time? I feel like I'm just a total. I don't believe in it anymore. I think more than the majority of Americans feel this way, and that's got to be sorted out through all of this. And then finally, I think that for investors, you have to realize that interest rates are not behaving the way they used to. The Federal Reserve cut interest rates starting now 175 basis points starting a year ago, September, and long-term interest rates are going up. They're not going down. And so I'm of the opinion, I've stated this in the past, and so far the markets have corroborated what I've been talking about. When the economy weakens, and certainly parts of it have already, interest rates at the long end are going to go up. And this, I was listening to a podcast where there's a fellow talking about this. He was pointing out the fact that as the Fed cuts interest rates, long rates don't come down. And then he slipped into the old habits. And this is what we have to be careful to avoid. 10 minutes later in this podcast, the guy says, well, maybe housing will become more affordable if the Fed cuts rates a couple more times. This is 10 minutes after saying when the Fed has been cutting rates, rates are going up on the mortgage market. And I think that what fundamentally drives, and I'm getting a little bit ahead of things, but I'll just tease this out. One of the fundamental things people have to understand is that interest rates are not, you cannot map 1980 to 2020. You can't take those patterns and map them forward. One final thing that I was just a comment on 2025. Jay Powell started 2025 in the most confident manner that I'd ever seen him in the January press conference. So we're in a great place. We're exactly perfect. Our mandate's going exactly right. Unemployment's still low. Inflation is still falling. And with every meeting, it got shakier and shakier until the last one where he says, well, when you're driving in a fog, I guess you just got to slow down. I don't even know what's going on anymore. you know, and the taper tantrum of late March into April, you know, there's been 13 corrections in the S&P 500 since about 2010. There's been 13 of them, and that was one in that tariff tantrum period, dropped about 18%. The 12 that happened prior to 2025, in every case when the S&P went down more than 10%, the dollar went up. Every single time, and it went up about 8 to 10%. Not this time. This time it went down 8 to 10%. So the dollar is no longer perceived as a flight to quality asset. And that's very, very important to keep in mind. So interest rates are not behaving the same. The dollar's not behaving the same. I think to be more granular in analysis is the most important thing in the markets today.
I'll take that, and we'll pivot to the Fed a little bit, because we've heard the administration, specifically the Treasury Secretary, come out and say that we need to cut rates. We need to do so. Lutnick says it all the time as well. We got to cut rates at the Fed so we can get mortgage rates down to solve the affordability crisis, right? And I always say that the only way to solve the affordability crisis, it's not moving interest rates even 200 basis points.
Those loans.
You need to bring prices down, or you need more supply massively, right? But this is the guys they're using. So what gives with the Fed here? I mean, yeah, the cutting, but is it really this idea of housing, Rosie? Or is it they see the weakness here? I mean, it's obviously there's a big debate at this point. But why do you think, let's pull it out of the Fed, why do you think that the administration is looking at it and trying to go that direction? I have my own inklings, but
well, I don't want to speak for Donald Trump's approach regarding the Fed, although I probably do share his interest rate forecast. I think actually that he picks on Jay Powell, even though I would argue, and it's probably irrelevant because he's a lame duck, and he won't be around after May, at least as Fed chairman. But I would say Powell is probably the biggest dove on the FOMC. So I don't know why he's picking. Maybe he should pick on Goolsbee or pick on the committee. Powell is definitely not a hawk, but you have a very divided Fed. So I would say that a couple of things. The first is just something that Jeff Gundlach had mentioned about the leading economic indicator not doing its traditional job, because it's been telling us that we're going to have a recession, and we haven't had the recession. And I think it comes down to the fact that maybe, although the S&P 500 is in the LEI, I think it has only a 10% share. The correlation between S&P 500 and GDP is now 95%. And when I started in the business in the mid-1980s, the equity market guys would go to the economists and say, what's GDP going to do, so I can make a formulated view on the stock market. Today, the economist goes to the equity strategist and says, what's your S&P 500 target? Because I got to put that into my stock market model. The equity wealth effect on spending is the highest it's ever been. It's even taken out a very similar situation that we had back in the late 1990s. So I would posit that the LEI has got it wrong because it doesn't have appropriate weightings, because it should have a much higher weighting for the stock market. And that's what the leading indicator has missed. So basically, everything comes down to the stock market for the economy. Everything comes down to the stock market. And I mentioned the unemployment rate. I do want to make just one thing. I want to come back to the Fed, but I want to make one thing about what Jim Bianco said, which is that if, in fact, this was a situation where the depletion of the supply of labor was dominating the demand for labor. So frankly, I don't really care if it's 40,000, the break even, when employment, the demand is zero. It doesn't matter. If we have a situation, for example, arithmetically, where the labor supply is going down 50,000, but the demand for labor is going down 100,000, I don't care. I'm looking at the supply and demand curve of labor to determine what is happening to something that's going to be very important this year and for the Fed and for everybody, which is nominal wage growth. So the reality is that the unemployment rate is going up. Imperfect statistic, perhaps, but it's going up. And not just that, as Danielle had mentioned, the broadest form of unemployment, which is the U6, the broadest measure. It includes people that are on the sidelines wanting to take a job but haven't officially entered the labor market yet. It includes discouraged workers. So the U6 is at 8.7%. It's at a 5-year high. It was 7.6% this time last year. So no matter whatever it is Jim Bianco is saying, what I'm telling you as an economist is that the idle capacity, the spare excess capacity in this very important market called the labor market, which ultimately determines 80% of national income and 70% of GDP, consumer spending, that the labor market slack is widening. I frankly don't understand the Fed as a whole because there's a lot of hawks. And I think that these are human beings. They're not robots. And I think there is still this collective shame years later over transitory and missing the inflation bulge, the 18-month inflation bulge that is going in the hall of shame. And that still lingers with the hawks to this day. And Powell has to navigate through this thing so he doesn't have a mutiny. So here's the way I see it as far as the economy is concerned, okay? Because we talked about the unemployment rate, but there's another rate called the savings rate, the personal savings rate. And when an economist talks about the personal savings rate to a CIO or portfolio manager, their eyes just glaze over. But I would posit that there is not a more important behavioral aggregate in the economy than the personal savings rate. That decision at the margin, how much of my after-tax income do I spend or do I save? And when you multiply that across 130 million households, it has a monumental impact on the economy. So let me just say this, okay, because it comes down to it's all about the stock market. That in the past 6 months, the personal savings rate has gone from 5.5% to 4%. That is epic. What that means is that collectively, and it might be concentrated amongst the fat cats, but it's an aggregate number. But almost all the growth in the economy, and that includes the AI spending boom, which is growing, but still a relatively tiny share of the overall economy. It's expanding. But the savings rate going down 150 basis points is incredible boost to the economy. And it's coming from the fact that people feel comfortable looking at their 401ks, looking at the stock market, and they believe that the pot of gold at the end of the rainbow and their comfortable retirement lifestyle expectation, they are spending more and more for their after-tax income. That savings rate, by the way, at 4% is half what it was at the end of 2019 before COVID. So that's basically the behavioral aspect of this coming from the stock market. So because we're also narcissistic, we judge the economy based on GDP. But there's more than one measure of the economy. GDP is spending. There's the spending accounts, the product accounts, the income accounts. Now, everybody went crazy over the GDP number at 4.3, but nobody really knows that real gross domestic income was only 2.3%. It wasn't 4.3, and it was all profits. The real personal disposable income, the past 2 quarters, real PDI, excluding government transfers. And this statistic, by the way, is what the National Bureau of Economic Research uses as one of its 4 cornerstones for determining the contours of the business cycle, okay? Flat each of the past 2 quarters. So all I get is how great the economy is doing, because we're focused on the spending side. But nobody's focused on the income side. And what's keeping the income side afloat is corporate profits. By the way, today we got the productivity numbers, and it showed that the labor share, it's something that Charles mentioned, the labor share of income in the U.S. economy has gone down to an all-time low. The point is that real disposable income, excluding government handouts, has been zero growth for 2 quarters in a row. So we're at a knife's edge. If you're asking me about a recession, well, maybe not evident on spending, but it's becoming maybe evident on the personal income side. I come back to the fact on the Fed that they have a dual mandate. Powell gave us a ton of information at the last meeting when he said that when you strip out the tariff impact, core inflation is running in the low 2s. So for all the inflationists out there, what is your problem? Okay? We've done the work and we found that the tariff impact so far, it's not been monumental. It's added 40 basis points from the core goods CPI. It's added 40 basis points. So we have inflation, say at 2.6, it's really 2.2. And then Powell told us that and then we don't know how the Supreme Court is going to rule, who knows. But he said that the impact of the tariffs under quid pro quo peaks out this quarter. So done. And we're at 2.2x tariffs. And then we're going to have the follow through, which he mentioned about that we haven't seen the full thrust of the rental deflation. So we're talking about elevated home prices, but that's starting to slow down as well. But rents have been deflating for the past 18 months. And because of the distributive lags in the CPI, for those that follow this thing, because we're a bunch of nerds here, so we do, I'm not assuming that you do, but there's going to be a ton of shelter disinflation, deflation hitting the CPI. Now, December's number is going to be ugly, and then we don't know all the insurance premium and healthcare in January. So I'm going to say the next couple of months will be bumpy. But I think that when I trace through the removal of the tariff effect and the impact we have yet to see from rental, don't forget that rents, owner's equivalent rent, and real rents are basically a third of the CPI and 40% of the core CPI. So all you have to do is get that right, and you'll get your inflation number right. I actually think there's a good chance, by the way, you can write this down, I think that inflation and core will be gravitating towards 1% by the end of the year, okay? The unemployment rate's going to 6% based on our numbers, okay? Because we're seeing, and by the way, if what Jim was saying was correct about the break even, now I don't really care about the break even as much as, well, what's the demand for labor doing against that break even? It's very clear that the unemployment rate is going up. And it's very clear to me that nominal wage growth is decelerating. Nominal wage growth is decelerating. Daniel mentioned that. Nominal wage growth would not be decelerating if the depleted supply of labor was dominating the demand. You would not be seeing nominal wage growth decelerating. That would make no economic sense. So I think that the Fed is on the wrong side of the track as a group. I agree actually with Donald Trump's interest rate forecast. I 100% agree. I don't really like his approach very much. I think that that's one of the reasons maybe why the long end of the curve hasn't done so well is because they don't really like all this political interference. They don't really like all these fiscal deficits. However, that's why the long end of the curve to some extent has lagged behind. That's one of the reasons why I like the front end of the curve for this year as a tradable strategy. They have 2 rate cuts priced in too. That's not enough. And when I trace this through, by the way, I trace through what inflation and unemployment are going to be doing, and that's the Fed's mandate. They are so far behind the curve that I think that the policy rate in the U.S. will gravitate on where it is in Canada and where it is in Europe. Like we'll be getting down to 2%. I actually think we will close the year with the funds rate at 2%. And I don't frankly care if it's Kevin Warsh, Kevin Hassett, or Kevin Costner. I don't care, okay? The Fed will follow the data.
I prefer Kevin Costner.
And I haven't placed a bet.
We don't know this rate view though. Except Rosie sounds like he's throwing his hat in the ring because he's agreeing with the rate forecast.
Yeah.
He's saying we should cut. You sound like you're kind of lobbying for the job right now.
Well,
Because that's the univariate thing that Trump looks at.
Tough for
It'd be tough for me to get that. That H-1B visa won't be so easy for me to get.
But you got 5 million? Come on, man.
But I think that I think that the last time I placed a bet against the Fed to this degree was probably back in 2007. So,
And you forgot to mention what Powell also said at the last press conference, and that is that they're working under the assumption right now, and we know that private core employment peaked in April of this year, excluding education and healthcare. You've always got to send your kids to school. You've always got to get sick, and there are more people getting sick now as baby boomers age. But Powell referred to that. He and Waller follow it very closely. But that employment peaked in April, and he said at the podium, which you wrote about, Dave, that he basically told us we've been losing jobs since May.
yeah, so the overstatement 60,000. Well, look, the thing is, you don't even have to go there. You know,
But Powell did.
well, Powell did. See, the thing is that, and this is getting a little technical. When we get the non-farm payroll numbers, then we'll get a December number tomorrow. That number you see, whether it's plus 150, plus 40, it's the sum of two numbers. Okay, there's the actual survey. There's the actual survey, and then there's the birth-death model. I just want to see a show of hands. Who knows when I'm talking about the birth-death model? Okay.
Oh, you guys
I've
get
got,
it out more.
they actually do, it used to be called the plug factor. We used to call that the plug factor. So they're always trying to estimate employment from net new business creation because they have their existing survey of companies, and then they try and adjust for new companies. So business creation minus business failures. So a lot of this is absolutely guesswork. The reason why the BLS commissioner got fired is they realized in this birth-death model that they're using, they were dramatically overstating employment. And of course, the accusation was, yeah, overstating employment during the Biden years. That's great. But now we're seeing the reverse happen right now. But getting the politics out of it, the reality is that employment was dramatically overstated. And when you're taking a look actually at 2025, now we don't have December's data yet, we'll get it tomorrow, but did you know that if you actually stripped out this birth-death guesswork and just looked at non-farm payrolls from the actual survey of establishments, did you know that employment actually contracted 500,000? 500,000 for 2025. So that's basically what? That's almost like, call it negative 40,000 per month without using my Hewlett Packard calculator. So I don't know. So Jim Bianco says, well, the break even 0 to 50. Good, because we're losing actually, in reality, 40,000 jobs. That's why the unemployment rate's going up. It all makes sense. What doesn't make sense? What does not make sense? Now, this is just a collective median forecast from the Fed, but do you know, and this is crazy, that their forecast for the Fed believes, if you look at their last projection from the December meeting, that the unemployment rate is going to be 4.5% by the end of this year.
We were on set.
And we're at 4.6 right now. And I'm looking at this forecast thinking, I'm back in I'm going to actually put, yeah, okay, so I'll be a bettor, okay? I don't know if there's a betting pool on this. Well, there is. There's a swaps market. That there's not a snowball's chance in hell, I don't think, that we close this year at 4.5. And if we close the year, I think, because we're modeling out, we use a bunch of different models, there's a good chance we finish the year at 6%, which I think a lot of people would say, well, by the historical norms, that's still relatively low. Well, the stock market's going to have to do a whole heck of a lot to generate this ongoing wealth effect on spending at the high end. If the unemployment rate does what I think it's going to do, and what impact that's going to have on nominal wage growth for the little guy and the middle income household. It's going to be a big trade-off. So let's hope the stock market does what it's going to do, because that's going to dictate what the economy does. But you can see basically that inflation is going to come down below their 2% target, and unemployment's going to 6%. The Fed's own estimate of the full unemployment rate is 4.2. All I ever hear about is, well, inflation's above target. Inflation's above target. They're too high above target. I couldn't believe that Goolsbee from Chicago, that's your area, was on CNBC. We're still too far above target. Kashkari. Like, what are you talking about?
Powell just told you ex tariffs, you're 20 basis points above target. Meanwhile, as it stands right now at 4.6, the unemployment rate, the other part of your mandate, is 40 basis points above target. And if we go to 6%, I have a tough time believing that we'll escape the recession that never came to be. I know that nobody wants to call for recession because the people that did that, including me back in 2022, 2023, we got pasted. The recession didn't come. Now, there were a bunch of reasons, and back then we still had the $2 trillion of excess fiscal stimulus that were sloshing around helping the consumer out. But you see, the thing is that employment was not stagnating and going down back then. Back in 2022, 2023, despite the Fed rate hikes, the labor market was actually fairly vibrant. And you don't get a recession, actually, without a deteriorating labor market. But the labor market is deteriorating. And you look at the leading indicators of employment, that's going to be a big story this year. There is no income tax refund. There's no tax on tips. There's nothing that is going to be more dominant than the labor market this year. And then that's going to have ramifications for the midterm elections.
All right. I'd like to ask the rest of you. We're running out of time here because of Dave, but
I'll put the tape on, okay?
So well, you're good. There was a good flow of thought. Jim, your name was mentioned a bunch in there. You want to defend yourself or compliment David?
Yeah, I'll say a couple of things, and then I'll come back to the original question on the Fed.
Oh, that.
Yeah, I did say they're going to 2%.
I mean, he did call you by name a few times. I thought I'd just give you a chance.
I did say they're going to 2%. I just
In every
gave a treatise.
I'll say this. I'll make the feel off something you've said. I've always argued that every recession or financial crisis, the economy changes. Change is not worse. Change is different. It changed a lot after 2020. We're in a post-COVID world right now. Danielle talked about, the pendulum swinging with labor. The last time that they reweighted and redid the leading economic indicators was 2011. So the model that they're using now, they invented in 2011. From 2011 to 2020, it actually worked pretty well. And the fact that it keeps printing negative, and I actually know this, like for the last 48 months, only like 4 of the months have been positive. The other 44 have been negative. Is the model that you're using, this is not the post-financial crisis economy anymore. That's really what the model's saying. There was a UK statistician named George Box, and he famously once said that all models are wrong, but some are useful. And the leading economic indicators is useful because it was modeled for the pre-COVID economy, and it's not working for the post-COVID economy. So this is different. Jeff talked about, we're looking at the aggregates and we need to break it down. And you talked about the K-shaped economy. This is all part of the same. This is not the pre-COVID economy.
Coefficients have changed.
Yes. And so, that's where we go from there. As far as the labor market goes, I would still argue that the change in the population growth needs to be understood better. We only have estimates. We only have guesses on it right now. I'll give you one statistic. If you look in the Los Angeles County, which is where we're sitting right now, bus fares or bus ridership in Los Angeles County year over year is down almost a quarter. Now, why is it down almost a quarter? Is because undocumented workers typically use the bus in Los Angeles County, and they're either afraid to go to work or they've been deported, and mostly they're afraid to go to work, and that's showing up in the bus fares. There's been a fundamental change in lots of the labor market because of this immigration change that we've seen in this economy. I'm not going to pretend that I understand it, but I will appreciate this is not even the same labor market that it was 14 months ago. This is a much different labor market. So I want to make a quick comment about the Fed.
You're answering the question now.
Yeah. In May, we're going to get a new Fed chairman. That part we know. We don't know who it's going to be. Trump keeps teasing that he's made up his mind. He's been saying that since Thanksgiving. He said it again this morning that he's made up his mind, and that he interviews somebody else. It's basically the way that he keeps going. But there's been a fundamental shift about the way that the Fed works. In the mid-1980s, just real fast, Paul Volcker was the Federal Reserve chairman. They had a vote to cut rates Volcker did not want to cut rates. The committee voted to cut rates. Volcker immediately resigned in the middle of the meeting.
Yep.
Wayne Angel, who was the Fed chairman, went into his office, talked him into coming back into the room. They had another vote 10 minutes later, and they voted to not cut rates, and he unresigned.
He was really the chairman.
Yes. And ever since then, the way the Fed works is the committee members talk among themselves before every meeting. They all express their interests and their desires and everything else. And then they vote with whatever the chairman wants. And that's why every vote is 12-0, 11-1. That's changing now, that the committee members are now starting to show some independence. Nick Timiraos, who's the Wall Street Journal Fed watcher, pointed out in an article the day before the December Fed meeting, if you tallied up all of the public comments of the 19 members of the Fed, now 12 of them vote and they rotate, it was 10 to not cut rates, 9 to cut rates. Let's call it 50-50. And then we had a 9-3 vote. We only had 3 dissenters, although if you tallied up the 7 to 12 voters, it should have been a 7-5 vote. Now, point is, we're moving towards more independence within the Fed voters. I've argued that this is a positive development. As a Fed official who votes at the meeting, your boss is not Jay Powell. Your boss is the American public.
Mhm.
And you're supposed to represent them in everything, including the votes. You don't need to appease. The chairman's a vote, you're a vote. He could vote his way, you could vote your way. The problem we're going to face after May, and this might be the holdup with somebody like a Kevin Hassett, is they'll come in and they'll make the case that we need 2% rate, or what Trump says, a 1% rate. But we're going to be down to vote tallying. Is there 7 people on that committee that are going to vote with him to move the needle? Otherwise, it might be a case we haven't seen in 40 or 50 years. The chairman wants to cut rates, but the bulk of the committee doesn't want to cut rates, and there won't be rate cuts. And that's really, I think, what Trump is looking for, is a strong personality who will kind of force his will on that committee to go along with what he wants. But that is going to be the biggest thing I think is going to happen, is after May. We'll get a new Fed chairman. Everybody will tell you what he wants, what he means. But really the question is, are there 7 other people that agree with him that are voting with him? And that's the open question.
Well, speaking of, it hasn't happened in 40 or 50 years, and this is something that I've thrown out there, and Kalshi's got a betting market on it. If Powell chooses to stay on and finish his governor term, which ends in January of 2028, history has dictated since the founding of the Federal Reserve that when you get a new chair in the middle of the year, the 19-member committee votes for the new president of the Federal Open Market Committee, which is different than the Federal Reserve Board. If the independence is truly, truly going to be exerted by every single one of those 19 individuals in the most extreme, harebrained situation, should Jay Powell decide to stay, they could elect him at the May meeting to continue being chairman of the Federal Open Market Committee for the rest of the year. They could elect for him to be chairman of the Federal Open Market Committee for all of 2027. There is nothing in the law that says each of the 19 votes does not have equal weight in electing the chair of the FOMC, which is different than the individual who the president nominates and the Senate confirms to be chair of the Federal Reserve Board of 7 individuals. That would be mutiny, and that would make Trump's head completely explode if he had to see Jay Powell behind the podium between now and when he leaves office, in theory, in January of 2028. But there's nothing illegal about it. And Jim is right. This is the closest we have seen in modern history to the mutiny that Paul Volcker sustained and got passed. But nonetheless, it was mutiny. But I don't think that any old chair who Trump throws at this committee will exert the same power and have the same influence that a Paul Volcker would have had all those years ago. I think the game at the Fed has changed.
On that note, I want to pause here because we are running a little bit over time, and I'll pick it up on the next segment as we lead into markets, because I definitely want to hear what both of you think about this. But let's take a break real quick. Let's let our listeners at home go take a bathroom break. Our people here. We're going to take about a 10-minute break, and we'll be back we'll start up in about 13 minutes. So.